Greetings and welcome to the third topic of Principles of Accounting by Study Space. In this topic, we'll be studying about adjusting entries and how they are accounted for and what principles and what methodologies are brought into effect in order to account for them. So adjusting entries are basically entries that need to be accounted for after a trial balance has collected all the balances from all the ledgers. So after we have our trial balance, we then perform our adjusting entries, after which we have our adjusted trial balance. This adjusted trial balance gives us a complete balance after taking into account for all our adjusted trial entries. So there are certain principles and rules that we need to take into account when we're creating this trial balance. The first rule that we will be studying is the fiscal versus the calendar year rule. Now in the fiscal versus the calendar year rule, we basically understand that accounting years are divided into particular time periods. They can be longer or shorter than a normal year. So basically a fiscal year may be from Jan to December, like a normal calendar year, or some companies may have different fiscal year. Now the second rule that we look at is the accrual versus cash basis rule. Under this rule, we assume that not all accounting records are on the basis of cash, but in fact we also have a system of credit within it. This means that our net income will not exactly be equal to the cash that is brought within the company, but in fact there will be a slight difference taking into account our receivables and our payables. Then we will be able to tell how much cash has been brought into the company. That is why we created a statement of cash flow in order to evaluate how much cash we have into the company, instead of simply assuming that our net income is equal to our cash. Now the other two principles that are extremely important are the revenue recognition and the expense recognition principle. Under these principles, it is believed that any expense or revenue incurred within the year must be accounted for within the year. So for example, if we had 1800 expense for insurance this year in 2017, we would charge an 1800 even if we paid around 1500. The remainder 300 would be noted as insurance payable, but we would charge 1800 as our expense of insurance paid. So these principles are extremely important when we are accounting for adjustments after a trial balance. Moving along, we will now see how and what type of basic accruals and different adjustment entries exist. So moving along, we will now look at the first type of adjustment entry, which is going to be our prepaid expenses. So under the prepaid expenses heading, what prepaid expense means is that we have already prepaid a certain expense. Therefore, the expense for this year will not be paid by us. However, due to the effect of this already paid expense, our assets are overstated and our expenses are understated. Therefore, an adjusting entry is formed in order to fix this problem. That entry is basically our expenses are debited and our assets are credited in order for us to properly be able to account for this entry. The second type of adjusting entry that's common is unearned revenue. Unearned revenue basically means that a customer has already paid us for a service that we have not yet provided them. So this basically means that our liabilities this time have been overstated and that our revenue has been understated. So therefore the adjusting entry for this is debit for liability and credit for revenue. Continuing with the type of adjustments, we have our third type, which is accrued revenues. Under this adjustment, the basic belief is that the assets have been understated and our revenue has also been understated. What an accrued revenue basically means is that we have provided a service but not have received our payment against it. So that means that what basically, for example, we have painted a house but we have not been given the cash payment back for it. So the treatment for this entry is that debit for assets and credit for revenue, because this would then raise the revenue which was understated and also raise the assets which were understated. The last commonly type of adjustment entry is accrued expenses, under which our liabilities have been understated and our expenses have also been understated. So in order to correct this, we would debit our expenses and credit our liabilities. Now another type of adjustment entry is depreciation. However, we won't be studying this in detail here. We will be studying this in detail in chapter 10, but depreciation is basically reduction in an asset's life. As the asset is used over time, it becomes less and less efficient, and therefore we reduce the asset's life by bringing it down to its fair image. So for example, if we bought an asset for 5,000 in 2012, we would depreciate it by 3,000 to bring it down to the fair image, that would be 2,000 for 2017. That's it for this video for now. We will be discussing further types of adjustment entries and solving a question in our next video. I hope to see you again in our videos, and if you have any questions, you can refer to the books, as they have a lot of example details and a lot of question material for you to try for yourself. Thank you.